Hey, Bridget, I was talking to a friend of mine the other day, and he said that his company gave him some restricted stock units, and we was just over cocktails, and he said, "Hey, what things do I need to know, and how do I think about these?" And I thought that's a really great question to dig into. That, of course, you deal with that with clients, as do I. When a client asks, you says, "Hey, I got new RSUs. What do I do with these things?" Or, what are the pros? What are the cons? How do you talk about it with clients?
First, I say congratulations. It's an awesome question to have. So
Yeah.
RSUs are sweet. So let's talk about them. They're generally part of someone's compensation plan. All right. So they're part of your comp and they grant them year one. And then typically the vesting is starts the next year and then goes over a series of years. And often it's 3 years, 3 of us.
Yeah.
And
Yeah.
so that means that every year, and sometimes if it's every month. So sometimes it's like you're getting these all the time. So it depends on the company. And so when they vest, then you get the shares and they're included, the price of the shares minus some tax is included in your compensation. So that'll be on your W-2 when you get these shares. So that's the first thing to understand. Anything to add to the basics?
Yeah, no, I think that that's a great explanation. And how I talk about it is it's like getting a bonus, right? You got, X number of, so they give you 75 shares of stock and you get 25 each year that vest that become yours. And it's just like getting a check or a cash, except for it's in stock, right? So there's some other opportunities that come with it, and it kind of ties the person to the company in some fashion, right? Hey, I want the company to do well, so my shares go up in value. Um, yeah, I don't think I've got anything else to add other than just in thinking about it, it's like getting a bonus, but in stock, right?
Yes, right, absolutely. So then the shares either go up or down. Okay. And if you hold on to them for a year, then any gains are capital gains. So they're taxed at a lower rate. Okay. So I think that's what
Yeah.
the companies have in mind when they include them in comp and when they basically give them, include them as part of your compensation is that you'll hang on to them and you'll care more about this company than you ever did before because your future is tied to this company.
Let's walk through that if you could. I love this. Let's
Yeah.
say right now I come to you, I'm your client, I say, "Hey, Bridge, I got these, I got 20 75 shares. I get 25 that vest each year. So next December, I'm going to get 25 shares that vest, right? So
Right.
company stock is, let's say, $100 a share, whatever it is. It goes through the year. I know what it could maybe be worth, but I won't know what my 25 shares are worth till a year from now, right? So
Right.
next December we sit down and now the company's gone up. It's $110 a share, or it's gone, whatever it is. I still get that 70, that 25 shares times the share price.
Right.
That's my bonus for the year.
Right.
Now, next December, I own 25 shares of XYZ company, right? So I own 25 shares of that. That value shows up in my W-2, right?
Right.
So there's tax withholdings and that. I don't have any money yet, right? I own
Right.
stock. That's one of the things that can be a little bit of a, not a gotcha, but just to be aware of, like, hey, I got to pay
Right.
tax on that, but I don't have any cash necessarily yet, right? And then now that I own this stock a year from now, that's the point where I can say, listen, now I can do whatever I want to with those 25 shares, right? I
Right.
could sell them right away. I could hold them for a year, like you said, and then I pay capital gains basically in 2 years down the road, right? So it's sort of like two separate decisions, right? One, I get this bonus and it's in stock and I'm going to pay taxes on that. Then it's, well, what do I want to do with it? And one of the things we talk about with folks is at that spot, a year from now, we've got this. I've paid taxes on those 25 shares. If I wanted to sell right away, I could sell them and there'd be maybe no gain at all. It would be the right. I
Yeah.
could sell them, just turn it into cash if I wanted to.
Right.
Sometimes I can't do that. Sometimes, most of the time you can, in my experience. But right, so there's that. Then nothing happens. But in a year from now, I'm going to have that tax bill that attached to the stock, and then I've got some decisions to make. Right, it's not just, well, I'm done now. Now I got to think about, hey, I own this stock, right?
Right. Absolutely.
Yeah.
Yeah. So I would talk about when you can't sell. And that
Mm.
is if you're an insider. If you are an insider, you should know it. But if you suspect maybe you are and you're not quite sure, it's important to know the status. And so if you're an insider, then you're subject to certain trading windows. And this is because you presumably have inside information that might move the market if you told somebody else, and you have to be confidential about all the information that you share. So you can't just go selling stock whatever you feel like it. Okay, so it's slightly different for insiders than it is for the rest of the people. The other thing I see that happens is often people start at a company when it's young and small, and then they get some shares, they never sell them, and then they, what everybody's hoping for is the shares will go up. I'm sure there's, plenty of listeners that are in some of these companies that they got restricted stock units, they didn't sell them, and then they go way up. Okay.
Yeah.
And so then you have a lot of capital gains baked into those shares, but then they're worth a lot, and that can be a big part of your net worth. Okay.
Yeah. Good problem
And
to have, right?
yeah, yeah, yeah. But that's when we start saying, sell these right away. Like, so then on the new shares, we'll tell them sell them right away, because you don't need all your eggs in that company basket. Because sure, it's okay to have some shares in the company you work for, but once it gets to be a lot, what if they let you out? That's going to mean the stock price is probably going down and you're losing your job at the same time. So you're putting a lot of risk on one
Yeah.
thing. So owning a ton of shares. And then the other thing is that if you move up the ladder at the company, you might not even be able to avoid having a lot of shares. So they might be compensating you a lot with RSUs and other stock options, et cetera. So be that's a thing to be mindful of, is that owning a lot of it sounds good, but then it puts you at a lot. It really increases the risk, because if that stock plummets, you lose a bunch of money. And most of the people, if at this point, they've seen enough stock market ups and downs, so they get what I'm talking about. Sometimes people with new companies don't quite believe me.
Yeah, yeah. No, it's yeah, that all I love that. I was gonna pull on a couple of those threads there, but one of the things that we talk about is, is risk and concentration, right? Of
Right,
course, I have a lot of stock, it's one thing, but you think about where's your livelihood? Like my
right,
buddy, he's pretty well compensated, right? He's a tech wonk. So he's not, he's not doing the finances, he's not at the high, super high level. Like, all right, he's just got this bonus coming in. And his salary, if things go south with the company, right? The economy, whatever it is, his wages are subject to the company doing well. And if he doesn't want too much of his net worth subject to the company doing well, of course, when it goes up, it all looks awesome. But when it goes the other direction, right? Like, why
right.
take that risk? So that's one of the things that we really talk about. And I think the mistake that I see people make with RSUs is they vest it kind of like, if you sort of ignore it, it just shows up, right? Oh, look, my paycheck was higher and I got more withholdings, and just, you don't pay attention to it. And then 2 or 3 or 5 years down, suddenly you go, oh, half my net worth is in, my company stock, sort of a thing. Or, that type of thing where it sounds crazy, but it can be easy to kind of forget that, because not like I wrote a check for that stock, right? It's not like, it's just different. And so paying attention to it, and what we'll tell people, or I'll tell people, Bridget, is rather than thinking about it like stock, when those RSUs mature vest, right? So a year from now, when I've got that 25 shares time, whatever the price is, if I got that bonus in cash, would I buy that number of shares of my company stock today? Because that's effectively what you're doing, right? You think about it, I'm paying taxes. It's like I could turn it into cash tomorrow. And if the answer is, hey, a year from now, Bridget, would you buy $25,000 worth of your company stock? And if the answer is, yeah, I'd love to, great, then keep it. If the answer is no, if I got a $25,000 bonus check, I wouldn't buy more stock with it, then why keep it just because it came to you in the form of stock, right? And that's one of the reasons companies do it, to kind of get people, right? You kind of get attached to the stock, but to separate out and just think about it. If I had this in cash, because I could turn it into cash tomorrow, would I make this purchase? And that, I think, is a really helpful way to separate some of the emotions from the facts, right? And to be able to make a good decision about whatever's right for your situation.
Absolutely. And I am now christening that strategy the closet rule, because one of my friends, that's how she cleans out her closets. She thinks, if I would I buy this today? A
Yeah.
particular item. So would I buy this today? No. Okay, I'm getting rid of it. Yeah.
Isn't it?
So
Yeah.
yeah.
Yeah. That,
So
no,
it's
that's, I
like,
was just thinking about, because we're doing some of that, this time of year at our house, and it's like, oh, but I really like this, whatever, this shirt. Like, I haven't worn it all year, but I really like it. If I wouldn't buy it today, why would I keep it? Right? The
right.
exact same thing. I love that.
Yeah. So anyway, it's a good way to lighten things up. Another, all right, a little mini rant from Bridget here is that I think some of the forgetting about it is by design. I think that the companies all have to have a separate RSU custodian, a holder, and the websites are horrible, like all of
Yeah,
them.
yeah, yeah.
So that even though even our highly paid executives are asking us for help to freaking make these trades and understand and get a statement, and then
Right.
they can't find the tax, like if the God forbid the company pays dividends, because then they should report that on their 1040, and so then they need that 1099 and they can't find that, so
Yeah,
it's
yeah.
it's and the other thing is that you'd think that that would get better, or that, no, here's how they're designed. You log in and they're like, you have tons of money if you just stay with this company. Like that's
Right,
kind of what the message is. But,
right,
some of these might not vest for like 10 years. A lot of them vest
right.
for 3 years. But anyway, so that's the message, just don't leave the company. And they make it hard, I would say, to actually execute transactions. That's my 2 cents, is just what I've seen.
Yeah, yeah, no, I'm laughing just as, oh yeah, I have those tax forms and getting them and some cases there is no login for it. You got to call and all this sort of thing, right? It's a mess. So hey, I
Yeah.
think that's a great place to wrap things up though. And I'm going to remember the closet rule
Yeah,
when
me
I
too.
talk to clients about RSUs and remember to
Help
think
people with
about
their
it and don't
stocks
forget
and
about
help
them.
people clean the closets.
There you go. There you go. That's awesome. Hey, again, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
I'm Bridget Sullivan Ramel. I've got a fielding financial planning practice in Chicago, Illinois. John and I are both taking clients, but we also belong to an organization called the Alliance of Comprehensive Planners. And so if you want to meet in person with planners in your area, you can check acplanners.org.
Don't forget, hit that subscribe button.